Geopolitics to the forefront, even as the economy stays hot. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on the proposed gas tax holiday.
I think we are plumbing the depths of new bad ideas.
And Nikki Drexler on the state of the retail industry and where it is headed.
Right now, it's bingo. It's price bingo in America.
It was a week when we woke up every morning and looked to see whether Europe was still intact, with concerns about a possible Russian invasion of Ukraine, despite President Putin's protests to the contrary, even as he said he was running out of patience, and appearing with the German Chancellor Scholz, suggesting bombing might be necessary to stop what he called a genocide.
Allow me to add that in our assessment, what is happening now in the Donbass constitutes genocide.
But while we were all focused on Ukraine, we had more indications of just how hot the U.S. economy really is, with retail sales numbers for January surprisingly high.
Retail sales, a strong advance in January, a big rebound from what we saw in the month of December.
And corporate earnings continuing to pour in with mixed results, from Paramount CEO Bob Bakish falling short of expectations because of his streaming investments.
We would have peak streaming losses in terms of investment in 2023, and then they would improve from there, which would return the company to total earnings growth in 24 and beyond.
To blowout earnings from the likes of Walmart and Cisco, both increasing share buybacks. But in the end, the geopolitics and continued concern about the Fed won out over any positive news of the week, as the S&P 500 was down for a second week in a row, this time by 1.6%, putting it off by 9% for the year to date. The Nasdaq fell by 1.76% on the week, while bonds fluctuated but ended up not far from where they started, with the yield on the 10-year continuing to hover just over 1.9%. And oil actually was down despite all the anxiety over Ukraine, ending up at about $93 a barrel for Brent. To put this all in perspective, we welcome now Catherine Keating. She's CEO of BNY Mellon Wealth Management, and JoAnne Feeney, Advisors Capital Management Portfolio Manager. Thank you both for being here. Welcome back to Wall Street Week. JoAnne, let me start with you on this geopolitics. As you talk to your clients, how concerned are they about this? What do you tell them?
Well, you know, David, in the last week, I've actually fielded a number of calls with clients, and some of them ask, you know, why aren't more people talking about this on the investment front? So they're clearly concerned about the tensions in Ukraine, which seem to be escalating, in addition to the concerns we've been talking about for months, like inflation and interest rates and slowing economic growth. So, you know, they want to know if they need to do anything different in their portfolios. Do we need to change things for them, or are they well positioned? And the answer to that comes down to really, you know, what's their time frame? We've seen the world confront pandemics, wars, recessions. The stock market suffers for a while, but eventually recovers. So the time horizon for the investor really matters here, as well their risk tolerance for suffering through the volatility. So there are solutions out there, and the solution really depends on the individual investor.
Yeah, I agree with that, JoAnne. And in fact, when we think about geopolitical events, believe it or not, they tend to have very short-lived impact on the markets. What really matters is the larger ecosystem in which they're happening. So if we think about 9/11, terrible, terrible tragedy. Markets closed for 4 days. When they reopened the following week, you had a very significant sell-off, but within 2 months, that had actually been recovered. What was more important was the ecosystem that happened in. We were already in a bear market from the tech bubble bursting, and that market continued for a couple of years. I think the other thing that is important when you're thinking about war is, wars take time, right? We've learned that as a country. They take time. They can really impact your fiscal budget for a very long time.
Well, part of the ecosystem, though, Catherine, I wonder, is just volatility. We already had volatility because of the uncertainty about the Fed, triggered by the inflation and other factors. So putting more volatility into that, more uncertainty, what does that do to you as an investor? How do you deal with that kind of volatility going forward, Catherine?
So JoAnne said it right. Time horizon matters, and for most investors, their time horizon is actually quite long. They're saving for their retirement or maybe even their children and grandchildren. And so you can withstand volatility if your time horizon is long. The other thing I would say about volatility is, when we come out of a recession and a bear market, as we did over the last 2 years, those early months and years, everything goes in the same direction. It goes up. You don't have the normal volatility, and we haven't. But in fact, when you look at the S&P 500, the average intra-year correction over time is 14%. And yet 70% of the time, the market ends up by the end of the year. Yeah. So this is normal volatility. It just may not feel that way right now.
JoAnne, actually, Catherine just talked about a bear market. Is it possible we are entering into a bear market right now?
Well, in some areas of the stock market, we're already in a bear market. Right, look at infotech, look at other areas of growth, some areas of consumer discretionary communication services. A lot of these stocks have come down, well more than 10%. And their multiples have come down accordingly. And that started before really the Ukraine tensions really heated up. And it was primarily triggered by the Fed signaling that they were going to be raising rates and when rates actually rose. But, back to Catherine's point on the environment in which this higher risk has now arrived. We are the U.S. economy and the global economy still in the midst of a recovery from the worst of the pandemic. So we have a backdrop of production increasing, whether it's in industrials, consumer products, the housing market, right? And these are all trends that are likely to continue despite what is happening in the Ukraine, because, there's more and more production coming online. Cars, for example, have really been held back. And that should ease in the back half of the year, for example, as semiconductor production new factories come online starting in the middle of this year. So the economic environment is actually fairly positive. We worry, though, right, about the Ukraine situation and how the sanctions that may end up being triggered if this really goes forward will affect particularly the European economy.
Yeah, we would agree with that. And we remind ourselves about the business cycle that we were in when this global pandemic hit. We were actually in an expansionary cycle. It was the longest one on record. Companies were strong, consumers were strong. We got interrupted with this terrible, terrible health crisis. But coming out of it, as JoAnne says, the global economy is growing. It may not be growing as fast this year as it was last year, but it's going to still be nice growth. We expect 4% or so in the U.S. this year.
Catherine, I'm curious, going back in history, sanctions. We just heard JoAnne refer to sanctions. We had back and forth and up and down all week long, and at the very end of the week, President Biden came out and said that he believes, based on intelligence, that President Putin has actually decided to invade. Let's assume that's right. Let's assume that's right, and sanctions do come. In the past, what has that done to an economy and to businesses? How do you take that into account?
So for the global financial system, the impact of sanctions really depends on the size of the countries and their size in the global economy. And in this case, Russia and Ukraine are actually relatively small in the scale of the global economy. That doesn't mean, however, that sanctions on Russia couldn't have a very severe impact on Russia and its citizens and economy.
And also, right, the impact, even though Europe is voluntarily going to impose these sanctions, it's going to hurt the European economies. And I think that's probably the bigger risk. And, that's why you maybe want to be a little bit careful about some European exposure at this point.
Does it affect the length that you want to go? Do you want it to affect basically how long you want to invest for? Liquidity. Do you need to be pretty liquid, JoAnne?
Yeah, really depends on the investor. If they need liquidity in the relatively short term, then they probably want to be there already, right? So, if I'm talking to a client who's in our balance strategy and they're 70-30 and they know they're going to have some expenses coming up and they were just planning on selling stocks 6 months from now, they should probably be a little bit more conservative. And that fixed income, even though we're not expecting a lot out of the fixed income world, if you hand select bonds and preferreds, you can protect against some of the risks from rising rates, lock in some income and still be liquid. And so if the time horizon dictates that you're going to need liquidity, you ought to be positioned for that now.
Catherine, do you have clients going to cash or the cash equivalents?
Not really. Not really. When you think about liquidity needs for people, April 15th is a liquidity need, right? So we see people planning for that need every single year. We see it now, but no, we don't see clients going to cash because if you're a long-term investor, you need to stay invested. The market path is gently sloping upwards over time, despite these volatile periods in between.
Yeah, market timing is always difficult, particularly when there's a war involved, potentially. Thank you so much, Catherine Keating and JoAnne Feeney. They're going to be staying with us as we turn to the question of what we should expect from the rest of the year. That's coming up next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we are back with JoAnne Feeney of Advisors Capital Management and Catherine Keating of BNY Mellon Wealth Management. So, Catherine, let me come to you. We had this discussion, good discussion. I was going to ask you about the rest of the year, where the S&P 500 will be. Forget that. What about inflation? Because that's what everybody's talking about. Where do you see inflation now, and where's it going the rest of the year, do you think?
It is the most important question, actually, and it's the first one on everybody's minds. And I think to really understand it, we have to step back and reflect for a moment on what we've been through. As I said, we were in a healthy business cycle that got interrupted by a health recession, not a normal recession, a health recession. People were getting sick from this terrible virus. It made the economy sick. And then we got an unusual kind of medicine, right? We got this $6 trillion in fiscal stimulus in this country, which really changed some things in the recession. The first thing it changed is incomes didn't go down. That's very unusual. Incomes didn't go down. Spending didn't go down. That's very unusual. Normally in a pandemic, we tighten our belts. What happened was people kept spending, but they shifted their spending to goods, right? We weren't buying services. We weren't going on vacation, but we were buying goods, all the things we needed to work at home, the laptops and computers and monitors and all of those things. And all the things we needed to do, everything in our lives at home. And I think we're starting to get past some of that. We see some of the it was sort of an economics 101, right? You have all of this demand for goods and you don't have the supply to get them. We see that starting to correct a little bit. The fourth quarter was really a story about restocking inventories. And so I think the question about inflation is, does the torrid pace of consumers buying goods start to come off of its peak? And do we see more normal behavior, which is shifting to services?
JoAnne, do you have an answer to that question?
Sure, that's exactly right. I'll put on my economist hat here for a second. But yeah, when you have this demand so high and supply not able to catch up and interest rates not rising for various reasons, the only place the pressure valve can be turned is on the inflation front. And we should, towards the middle of this year, start to lap some of the biggest price increases. So with fiscal spending less than last year, and with a shift back over to services spending, we're already seeing that in the mobility data, more travel, more hotel bookings, more Airbnb bookings coming. That should take a lot of the pressure off inflation, particularly in the beginning of the year, plus more supply, as I mentioned before. More chips from the semiconductor companies mean more cars can be produced and everything else. On the other hand, though, we have to worry a little bit about the labor situation, because the pandemic did trigger an awful lot of people to just leave the workforce, particularly the baby boomer generation, and they're not likely to come back. So we have a shortage of labor. We're going to have higher wages. That's going to continue to keep the upward pressure on prices. But with the Fed's actions, with more supply coming on, with the shift over to services spending, it's likely that the torrid pace of inflation does ease a little bit through the course of this year, but it's going to take some time. Probably inflation gets worse as the housing price increases start to filter into the measured inflation numbers. As they've begun to do, it's probably going to get a little bit worse before it actually gets better.
Yeah, we would agree with that. And the thing about goods inflation is that it tends not to be very high, right? There's so much competition, so many brands out there competing for consumer dollars. Sticky inflation is what we really worry about. So we worry about rents and wages in particular. And if you asked us about the one thing we're most focused on, it is that increase in labor costs, because it's running at about 4% a year right now. And what we need is for the Fed to do what it will do, which is raise rates a bit. We need employers to do what they want to do, which is manage their costs and grow their profits. And we need employees to come back to the workforce. And there are things that we're missing, right? We didn't have the normal mobility and immigration over the last couple of years, which is very important. We didn't have mobility of people, be able to move from one place to another to take a job. I think the flexibility that a lot of businesses are adopting will invite people back to the workforce. And we need productivity, which actually we've been living a productivity boom. That's how you recover corporate earnings and recover all the GDP that was lost with fewer workers. We still have 3 million fewer workers.
JoAnne, you talk about pressure on prices. What about pressure on portfolio managers? Because in a world where you've got 2 or 3% inflation, a 5% return every year on your portfolio looks pretty good. In a world of 7% inflation, it doesn't look so good. Do you have investors basically saying, wait a second, how can I keep up with this inflation?
Yeah, that's obviously more of a problem for those heavily exposed to fixed income, right? That's where there's going to be a real challenge in keeping up. But, when you think about inflation and stock prices, you recognize that the source of inflation is coming from companies raising prices. They raise prices. That means their revenue goes up. That means their earnings go up. And, commensurately, stock prices tend to follow that. So there's a lot of protection in stock prices for inflation. Plus, you can always direct your portfolio more towards the sort of companies that do better when inflation and interest rates are higher. That could be banks, that could be real estate companies, that could be energy companies. So there are ways to build protection, and we've been doing that for clients for actually quite a while now.
So which stocks do you like right now?
Well, it depends on the sort of client. So for the sort of more conservative client, we're looking for stocks that'll deliver some dividend yield, for example, but that also can appreciate. So in the tech world, a company like Qualcomm or Cisco. For a safer play, a Philip Morris that has a very high dividend yield. And in the energy world, we like Chevron, we like Kinder Morgan. The energy demand is going to continue to be strong because we do think the recovery continues. Plus, by the way, that adds a little bit of insurance against this Ukraine-Russia situation.
So, Catherine, take a look at the rest of the year. As you look out, we can't know for sure. What do you anticipate for the rest of 2022? It's been a rough start to the year, I think it's fair to say.
I think I would say that we anticipate it coming back to a new normal. And what do I mean by that? I mean that we will still have economic growth, but it will be lower than it was, right? Maybe 4% this year in the U.S. We continue to think that stocks can do well, but it will be lower than they were doing the last 3 years, actually, when the S&P 500 almost doubled. We think that we will have inflation, but we think we will transition to a lower inflation rate. And in fact, the end point of inflation really matters, because if you have inflation between 3 and 4%, over time, markets can do very well. That's what it's been for most of our careers. So the end point for inflation really matters.
JoAnne, we've seen maybe a little of the bloom come off the rose in growth and go back into value. Do you anticipate that for the rest of the year?
Yeah, no, I think part of the reason why we've had this, what we're calling the great reallocation, right, has been because of the elevated uncertainty, the anticipation of higher rates. We saw folks get out of growth names into safer names, into real estate, banks, et cetera, energy. And the idea there was that, hey, economies are recovering and the rising tide lifts all boats. So why own risky things? Let's own some safe stuff. But as the economic growth does slow down, as is natural when you're coming off a very large recovery, it's going to peter out over time. I think investors are going to recognize that they can no longer get as much appreciation out of those traditional economic-oriented companies. And if they want to build appreciation into their portfolios for the longer term, they're going to have to go back to growth stocks. And if you look at some of the valuations, they've really come down. If you look at the broader infotech sector, for example, the valuations have come down 16 to 18% just since the beginning of the year. And that reflects that reallocation. So we expect a reallocation back towards the growth names as some of these uncertainties recede. And we don't know when that's going to happen, but we do see investors really needing to look for some sources of appreciation for the longer term. And we think that's a lot of the higher quality growth names. And so what we've done is to raise the quality a little bit in some of the growth names that we own. For example, we'll stay with a Palo Alto in the cybersecurity space, which, by the way, is a nice defensive position in case of war, because we do expect cyber attacks to coincide with this potential military event, instead of, say, an Okta, which is in the same space but has some management questions along with it. So we do expect a move towards quality and a move towards growth as we go through the year.
So one last one to you, Catherine, maybe an unfair one. You always like to be diversified. That's the way you hedge.
Yep.
Is there any reason to be in bonds right now, given rising rates?
So the answer is yes. So year to date, equity markets are down anywhere from 7 to 12%. So if you had a fully equity portfolio, you would be down someplace in that range. Adding bonds to that portfolio probably took your return to, down 7%, right, or so year to date. So you underweight, but you don't eliminate bonds because they do have a role in the portfolio.
And your investors are patient, are they?
They are patient.
Oh,
They're
good.
investing for the long term.
That's the kind of investor you want. Okay, thank you so very much. To Catherine Keating, CEO of BNY Mellon Wealth Management, and JoAnne Feeney, she's portfolio manager at Advisors Capital Management. Thank you so much for being with Wall Street Week today. Coming up, we look at the week ahead on markets around the world. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. It's time now to take a look at what's coming up in the days ahead on Global Wall Street, starting with Juliet Sally in Singapore.
Thanks, David. A busy week of central bank action in the region. The Reserve Bank of New Zealand is likely to hike rates further, while the Bank of Korea is expected to hold fire after January's hike, and Chinese banks will probably quote loan prime rates on par with the levels at January's fixing. Other data includes Thailand's fourth quarter GDP and inflation prints from Singapore and Malaysia. Elsewhere, Hong Kong's financial secretary delivers the annual budget this week, with the financial hub in a perilous position as the government remains steadfast in its dynamic zero COVID strategy. Meanwhile, Australia reopens its borders to vaccinated visa holders for the first time in 2 years. And on that note, Qantas and Singapore Airlines among the companies delivering earnings this week, along with mining giant Rio Tinto. Now over to Anna Edwards in London. Anna?
Thanks, Juliet. The geopolitical situation around Ukraine continues to dominate the agenda for investors. We'll hear from European foreign ministers when they meet in Brussels on Monday after the Munich Security Conference wraps up. Elsewhere, we get more earnings reports from major European corporates, including Barclays and Stellantis, and some important moments for monetary and fiscal policy. We'll hear testimony from the Bank of England Governor Andrew Bailey on Wednesday, and European finance ministers meet in Paris on Friday. Now over to Romain Bostic in New York.
Thanks, Anna. A shortened week ahead for financial markets in the U.S. because of the President's Day holiday on Monday. When folks return Tuesday, they'll be watching for market manufacturing PMIs and the Conference Board's consumer confidence data for a read on economic momentum. Later in the week, we'll get new home sales for January, durable goods orders for the same month, and an update on the Fed's favored measure of inflation, the Personal Consumption Expenditures Price Index, which the Fed officially targets as it aims for that 2% average annual inflation. That index has jumped 5% year over year for 3 consecutive months, and economists expect the latest data for January to show a 6% rise. It will likely add fuel to the debate on whether the Fed should be more aggressive in tightening monetary policy. There are earnings scheduled for the week, including retailers, Macy's, TJX, Home Depot, and Lowe's, as well as e-commerce platforms, eBay and Etsy. Also look for earnings from Dish, Coinbase, Caesars, Moderna, and Monster Beverage. David?
Thanks to Juliet Sally, Anna Edwards, and Romain Bostic. Coming up, retail sales are back up, but how long will it last? And what's the next new thing in retail? We ask retail guru Mickey Drexler.
I think sale is the enemy of any retailer.
This is Wall Street Week on Bloomberg.
Everything seems like it's going up.
I still worry about prices increasing.
Consumer spending. When it comes to the U.S. economy, it's one of the main indicators of how we're doing. So after retail sales trailed off at the end of last year, we breathed a collective sigh of relief when they bounced back strongly, up 3.5% in January, although some of that was really from inflation.
On a nominal basis, I say that very deliberately, of course, because we saw also inflation spike in the month of January. So we're not used to seeing these inflation and additional juiced sales in retail sales.
And the rest of 2022 may be a challenging one for retailers as money from that child tax credit expires.
We are concerned that the expiration of the child tax credit leaves millions of families without that added source of income that they really need to be able to support their families.
Of course, it's not only about how much we shop, but also about how we shop, with brick and mortar stores taking the biggest hit in commercial real estate from the pandemic.
I think there will be some conversions where possible away from uses that are not quite as valuable anymore, retail being the top one.
Even as online sales grew dramatically. And when it comes to retail, there's really only one person we want to talk to, and that is Mickey Drexler. He founded Madewell and Old Navy. He ran the Gap and J.Crew and built them into behemoths in the retail industry, and we're delighted to have him on Wall Street Week now. Mickey, thank you so much for joining us. Let's start with this pandemic. How did it change the retail business?
Well, I think it changed it pretty dramatically. I also think the changes were past due. Way too many stores in America, which is no secret, overstored, certainly helped the online business around. And I think it changed it also, and I don't think it's the pandemic, that there's so many companies now paying a lot of attention to statistics, I think more than merchandise. Lastly, I find it difficult that many companies in my industry, at least, for them, are not going into an office every day when it's critically important to see and touch merchandise. But I think it's changed it that way. I think it clearly changed the way people dressed for the last year or two. And there's changes, dramatic changes always going on. For a year, we've been up against what I call a snowstorm. Easy year, 21, up against really bad numbers. And I felt that starting this month, February, that it would get tougher again because the numbers aren't easy. People all had pretty good years, actually, surprisingly good, but they really weren't that surprising if you figure what they were up against. The money stopped flowing from the government, more difficult figures. And at the end of the day, for me, and always has been, I think the merchandise matters the most. Business, what I hear, because I'm a small part of it, what I hear is quite challenging and difficult in February and perhaps part of January. Supply chain issues, price of cotton has gone up, I think about 50%. Freight, so it's caused a lot of inflation in our business, and I think obviously in the retail business. So it's not easy out. I think we're headed for much more difficult times, but by nature, I'm always pessimistic.
So Mickey, let me pick up on one thing you've been talking about, and that is seeing and feeling the merchandise. I know you, I know the kind of retailer you are. You would walk around your stores and get a real sense of the merchandise and the interaction with people. How does that survive in an online AI world where artificial intelligence there, big data, things like that, or is that a thing of the past?
If it is, the companies, I think, look, it's about product. It's the only thing I know. Our business is extremely strong because, we're small, but I sit with the merchants every day. I sit with design, not because I'm the one with all the answers, because I've been there and done it. I've seen the movie a lot, and I've made every mistake in the book. The very young people kind of think when I make a mistake, they like to repeat that I made a mistake. I laugh. But in retail, predicting what's going to sell is a really important part of it. And the other thing is knowing what's kind of a day in, day out business year to year. But I think you can't be there, in my opinion, without being and watching the goods. And there's a spontaneity, a creativity that happens. I met a woman the other day who works in a company, 50 people, no office at all. And I said, how could you run a retail business where you're not looking and communicating. It's not just merchandise. I think, I don't know the finance business or your world, but I know in my world, the creativity flows regularly. You can get an idea anywhere, any place, any time, based on what excites you, stimulates you, or gives you a bigger imagination on what can be.
So, Mickey, how do you fit that with the closing of so many brick and mortar stores? We certainly around New York, around the country, it's really fallen off. Is that going to come back? Can you have that sort of feel, that touch and feel, without brick and mortar?
It's a good question. I think you can in the industry if, in fact, the merchandise, if you order online, paper towels, if you order anything that's simple, easy, and consistent, like the jacket I'm wearing, we don't not sell it. We've only, we relaunched the company, which Alex started about 7 or 8 years ago. It was doing well, but I thought Alex and I and a new designer who I worked with 15 years could do more. But we identify things like this that we don't intend to put on. Well, first of all, we never run a sale. I think sale is the enemy of any retailer. I learned that when Kush Balls, I don't think most of your viewers know what it is, on the same street in San Francisco where I lived for a while running Gap, it was in one store $1, the store next door $2, and it told me never to shop in the store next door. And right now it's bingo. It's price bingo in America. When will it be on sale? And there's this thing called online that helps all of us identify best prices. We made a decision early on that no sale takes away the integrity of pricing, and it's a moving target. So with us, it's never on sale. It probably cost us gross margin profit in the interim, but that's the way I think is fair, right? And we do that. So you're not seeing yourself, oh, I missed it by a week. I missed Friends and Family Day. I missed Thanksgiving, Black Friday. We don't even sell on Black Friday. Maybe it's a mistake. Long term will tell. But people are shopping for merchandise first, especially in our business. We're a fashion company. We appeal to relatively affluent clients, which was our strategy. But I've always felt good goods, good value, new goods, and I don't want to say old goods, but classics that, personally, this shirt there's a date on it, so I know. It's 14 years old. I could replace it, but why? Jacket's now 3 years old. And jeans, of course, are like 20 years old. So it's very easy to get up for me, personally. And me is not just me. It's never for me personally. It's for what we see as America and as a business we want to be in. Fashion is very difficult to play. You're always changing styles, changing.
So Mickey, I mean, you are really par excellence, the person who understands the product, feels the product, can anticipate the need. A lot of the people who are watching us on Wall Street Week are investors. Give them some investment advice, given what you know about retail. Are there good investments in retail right now? And if so, where are they, do you think?
Well, I don't know much about that. I don't really pay attention. I was on the board of Warby for 9 years, and that was, for me, a business that was tiny and small when I was there initially, that I felt had a great opportunity. For me, invest in companies that, frankly, in the fashion business, once they hit the wall, I've been there many times. I've made many mistakes. But when you get big enough to hit a wall, it's, to me, time to sell. And again, I don't invest on my own because I usually don't do very well. When I'm on the board of a company, I get a little lucky. It's good, like Apple or Warby, because the companies take care of themselves. I try to do the best I can do. But if I were a retail investor, because I always used to make mistakes early on, I invest in companies that I felt if there was a good CEO or if I could run it myself or whatever, then I like the company. But finding people who can run, lead, and have vision for a company is not easy, certainly in my industry. I like small, I like different, I like new, I like unique. To me, small is the new big, which is how I call us. We're a small company, and it's much easier to grow. Look, Walmart did $1. at some point, or $2, whatever the first day's volume was. It's much easier to grow small if you have the right goods, the right management, the right operations, and the right creativity.
It's really great to have you with us, Mickey. But as I say, the one man we always want to hear from on retail, that is Mickey Drexler. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston, and we are joined once again by our very special contributor, Larry Summers of Harvard. Larry, one of the things we've talked about is inflation, but very specifically, are the supply chain problems we're all seeing, are they a cause or the effect? A friend of yours, mine, and the program, Steve Ratner, had a column in the New York Times today basically saying supply chain is a symptom, it's not the disease. What did you make of it?
I think Steve's broadly right in distilling what serious economists believe. First of all, most of the goods where there's a bottleneck are having abnormally large quantity, not abnormally small quantity. So obviously, if you have a big increase in demand, you're going to encounter capacity limits. Second, what the supply chain people ignore is that if more money's being spent, for example, on used cars, yes, that's associated with higher used car prices, but it means less money's being spent on other things, and so it means less inflation in those sectors. So while it's a widespread view, I think the interpretation of inflation largely around supply chains is mostly a confusion and mostly an evasion of what I predicted a year ago, that if we overflowed the bathtub, we were going to get an overflow as the economy overheated.
So, Larry, one of the things that we're hearing out of the Capitol Hill this week is maybe it's not just all the Fed that can address the question of inflation. Maybe we should alleviate some of the pressure on consumers by having a hiatus on the gas tax, the federal gas tax. What do you think about things like that of limiting the cost to consumers?
I think we are plumbing the depths of new bad ideas with that one. First of all, gas prices are going to fluctuate all over the place, so nobody may see anything very substantial out of it. Second of all, lower prices for gasoline will tend to be offset by higher prices for other things as consumers have higher incomes and are able to shift spending to other spheres. Third, it runs exactly in the opposite direction of all the things we're trying to do in the environmental area. And fourth, you may get some, if you did get some little bit of deflationary shock when you put the gas tax holiday into place, you're going to get some offsetting inflationary shock when you remove the gas tax. It goes in exactly the opposite direction of paying for more infrastructure, which everybody thinks we need. Look, I think there needs to be a lesson learned about gimmicks that poll well. They're like sugar highs. They make you feel good, but they really often don't redound to anybody's substantial political benefit. What's remarkable is that all those much discussed tax credits, the $2,000 checks that were getting mailed to everybody, did substantial economic damage, and nobody remembers them. So they didn't even deliver the political benefit. So I hope we can step back and think about doing the right thing and move a bit away from trendy gimmicks.
Let me plumb those desks just a little more, because one of the other proposals is let's limit the prices of the things, such as, for example, insulin. Are we in a place where the inflation is so bad we may actually be talking about price controls?
Price controls are a ridiculous idea. Price controls are a prescription for shortage. They're a prescription for the non-availability of goods. Richard Nixon tried that experiment. It was a disaster then, and it would be an even worse disaster now. Now, look, I think there is a strong case for the government, which is the largest purchaser of pharmaceuticals in the world, to use its purchasing power to get a better deal for taxpayers and to get a better deal for consumers. But using your purchasing power when you're a large purchaser is a very different thing than trying to make rules about what price every business in the country should charge. So yes, I'm actually for activism on pharmaceutical prices, but I am not and it has to be sensible activism that preserves incentives. But across the board, price controls, that's a grave error.
As you have pointed out more than once, we have a mismatch between supply and demand, not just in goods, but also in labor right now. You've just co-authored a piece that I saw this week, really analyzing what the cause of that were. Is it really, again, a supply problem or demand problem? What did you conclude?
I think it's more of a demand problem. Look, David, we have, by a wide margin, the highest ratio of vacancies, jobs that need to be filled, to unemployed people that we've ever had. It can't be surprising in the face of that we're seeing very large nominal wage increases. And if you talk to businesses, they almost all feel that they can pass those wages on in the form of higher prices. And so that is the root of our inflation problem. Many people say that it's not entrenched, there's no sign of a wage price spiral. Not yet. I don't know what would be a sign of an incipient wage price spiral if an employment cost index approaching 6% and a CPI inflation rate in excess of 7% wasn't signs of a possible incipient wage price spiral. So I think we've made a substantial problem for ourselves. And I think if we don't recognize that it's at root a demand problem and we don't adjust monetary policy in a substantial way, it's only going to become a more serious problem.
Larry, going international here for a moment, we now are going to have the Olympics conclude, the Winter Olympics over Beijing this coming weekend. You were on a panel I saw, Institute of Politics up at Harvard, talking about China and how China is positioned right now globally, suggesting maybe it's not quite as powerful as some of us sometimes think.
I think that's right. I think we in the United States need to remember how wrong we were in our collective view of Russia in 1960 and how wrong we were in our collective view of Japan in the early 1990s, and consider the possibility that we may be underestimating China's challenges now. And we need to be particularly careful about being overly provocative to them. Our provocations with respect to Russia after 1960 contributed, many historians believe, to the Cuban Missile Crisis. And so, yes, we need to stand up for our interests vis-a-vis China, but I think we need to be quite careful to avoid a kind of strategic narcissism and truculence in the approach that we take.
Much of the news this week, as you know, Larry, was occupied with the crisis over Ukraine between Russia on the one hand and the United States and NATO allies on the other. I noticed, for example, that President Xi appeared with President Putin at the beginning of the Olympics. What did you make of this geopolitical crisis and how it fits into the world more broadly, and how long-lasting do you think the effects might be?
Let me say, David, that I'm not an expert on everything geopolitical, but it seems to me that as one who's been critical in a number of areas, this has been handled extremely well by the U.S. administration. That doesn't mean the ultimate outcome is going to be successful and that an invasion is going to be forestalled, but I think they've played the hand that they had in a very skillful way. I think this is a big deal, not because Ukraine is economically powerful. It isn't. Not even because Russia is economically powerful. It's not that powerful. But I think the question of whether there's some element of rule of international law and countries can't invade other countries with impunity is an issue that is very much here. And I think if this degrades, that will have costs for everybody's sense of certainty which, among other things, will affect the level of market valuations.
Larry, thank you so very much. That was very helpful. That's Larry Summers of Harvard, our very special contributor here on Wall Street Week. Coming up, from marble halls and teller windows to ATMs to apps. So what's next for banking? Why, the Metaverse, of course. That's next on Wall Street Week on Bloomberg. Finally, one more thought. Banking in the Metaverse. Having troubles in the world as we know it, worried about higher rates or a possible recession or tanks coming across the Ukraine border? Well, maybe tech has the answer for you and for all of us, for that matter. At this point, we've all heard about the Metaverse.
The Metaverse. The Metaverse. The Metaverse.
That term taken from a sci-fi book from 30 years ago and expropriated by none other than Mark Zuckerberg, who used it to rename Facebook Meta. And this is what he had to say about it when he made that announcement.
It is time for us to adopt a new company brand to encompass everything that we do. Our company is now Meta.
This week, Mr. Zuckerberg took it a step further in a memo to his staff, updating the company's values and what he called its cultural operating system, summing it up as focused on Meta, Metamates, and me. So Facebookers are now Metamates, which reminds me, at least, of when Disney bought ABC and the company started addressing people like Peter Jennings and Ted Koppel as castmates in employee emails. Well, let's hope the people at Meta embrace their new title with more enthusiasm than some of the folks at ABC News did back in the day. But it's not just Meta, nay Facebook, that's embracing the Metaverse. When Disney CEO Bob Chapek talked about his earnings just last week, he called the Metaverse a, quote, third dimension of storytelling.
I think it's a great opportunity for us. I think it's the next great horizon for Disney. I think it's the next great horizon in entertainment.
And don't forget toys in this Metaverse. The CEO of Mattel certainly hasn't.
The Metaverse, NFTs, and other digital opportunities, digital experiences will give us an opportunity to engage with consumers and create another opportunity for us to commercialize our brands and franchises in other ways.
To be sure, not everyone is sure what exactly the Metaverse is or whether it truly will change the world. Here's Eileen Lee of Cowboy Ventures.
I think the Metaverse is just like, what does that mean, really? If you mean the Metaverse, like, are we all going to be wearing VR headsets and staying in our houses all the time? I think that's, if we're lucky enough to emerge from our caves after this pandemic, I think at least for the next 3 to 5 years, people are going to be more excited to engage in real life than ever before.
But if we needed final confirmation that this Metaverse thing is going mainstream, it came this week from the big banks, with J.P. Morgan leading the way that is into Onyx. That's its name for its Metaverse Lounge, complete, of course, with a JPEG image of CEO Jamie Dimon, and accompanied by an 18-page paper on why the Metaverse is a $1 trillion, yes, I said $1 trillion opportunity. Now, if you want to get into the J.P. Morgan Meta Lounge, all you need to do is go to Decentraland's Metajuku Mall. Put that in your GPS and see what happens. That does it for this episode of Wall Street Week. I'm David Weston, and this is Bloomberg. See you next week.